Hello, this is Professor Randy Minton, and today I would like to go over the entry that will be necessary if you have prepaid accounts on your records. And typically there are 5 different adjusting entries that have to be made at the end of every accounting period. And the first is the one that I'm going to do today, the prepaid expenses. And then the others are unearned revenue, accrued revenues, accrued expenses, and depreciation. So this video will concern itself only with the prepaid account, and in this case we're going to look at office supplies. Office supplies is one of the very common ones that we will be adjusting from assets to expenses as we use these assets up. So without further ado, let me walk through an example of this. Now, let's assume for a moment that we have $1,000 in the office supplies account. And how did we get to that number? Well, at the end of the last accounting period, we went into the supply room and we took an inventory. So if we had 2 boxes of paper, for example, that $32 a box, we would have multiplied 2 times 32 and got 64. And then we would have done that for every supply that we have in the cabinet. And when we were done and added everything up, we would have had a balance of $1,000. Now, what happens with office supplies is people go in and out of the supply room. They typically will put down their name and the supplies that they have taken out, and that's done so that the supply clerk can then charge back to their department whatever their supply usage was. Now, in this case, we started out with 1,000, and over the course of the next month or so, we noticed that the supplies were dwindling in the office supply room. So we went down and we bought some more supplies. And we didn't want to have to do it every time we turned around, so we put in $1,800 worth of supplies. Now you'll notice that the current balance in the account now would be $2,800. However, we know that this $1,800 was something we just bought, so that's probably real. But this number here, the reason that we bought the $1,800 is because we saw a diminishing of this number. However, on our books, we're still showing $2,800. So let's go on now for 2 or 3 months later, and we notice again that the office supplies are starting to dwindle. So we go down and we make another purchase, and this time we buy $1,500 worth of supplies. So now, according to our book, we're showing $4,300 worth of supplies. However, again, we know that that's not true because we've probably exhausted the vast majority of these first 2 items. Anyway, 2 or 3 months later, we go down and we perform the same operation again. We go to the supply store, we buy another, let's call it $1,300 worth of supplies. So now, according to our book, we have $5,600 in supplies. However, we know that's not true, and we're now at the end of the accounting period. So we have to take an inventory to find out how much we actually have. So what we're going to do is we're going to make the same, we're going to perform the same task that we did before. We're going to go into the supply room. We're going to take each item that we have in there. We're going to multiply it times its cost. We'll add them all together, and when we do that, we find that we have $1,200 worth of supplies. What that means is that we used $4,400, and that usage is equivalent to the supplies expense. You'll notice what's happening over here is I'm making an adjustment, and the adjustment is to debit the supplies expense to recognize the fact that we have used up some of these supplies, and we're also crediting office supplies, the asset. The reason that we're crediting it is because office supplies, as an asset, has a normal debit balance. That means it goes up on the left-hand side and it goes down on the right-hand side. The left-hand side being the debit side, the right-hand side being the credit side. So what's happening here is we're having to credit the supplies account for the $4,400 that we have used. We have to do that in order to bring the account into balance, which is in this case $1,200. So that's the entry that you would have to make, and that would be the process that you would go through to get down to your $4,400 worth of usage, which represents the actual adjusting entry for the supplies. Now, the next question is, if we did not do that entry, if we didn't make the entry, what would happen in terms of our overstating or understating assets, liabilities, stockholders' equity, revenue, expenses, and income? In other words, what would happen to our balance sheet and what would happen to our income statement? Well, in this case, we overstate if we don't make the adjustment, because remember, what we actually have here is $1,200. What we're showing is $5,600. So if we don't make the entry, we actually overstate the amount that we have in office supplies by $4,400. Now, these run in the same direction, okay? Assets and stockholders' equity. So if we overstate assets, we overstate stockholders' equity. If we understate assets, we understate stockholders' equity. Now the same thing is true, and this, by the way, since we're overstating assets, we're showing them at $5,600 and when they should be $1,200. And again, this is if we do not make the entry. So if we're overstating our assets, we're also by definition overstating our stockholders' equity. Now, what about liabilities? Well, liabilities were not affected in this case. We'll deal with the entries for unearned revenues in a little bit, and that's a liability that we'll have to work through. Was revenue affected? No, it wasn't. Revenues, remember, that's your stream of earnings. Okay, this happens to be your stream of outgoing expense, or in this case, the using up of the assets. Now, if we do not make the entry, if we don't make the entry, we'll have an understatement of expenses in the amount of $4,400. Why? Because that's how many we used up. That's this number right here. So if we don't make the entry, we have understated expenses by $4,400. Well, expenses and income work in opposite directions. Remember that stockholders' equity, that section, has within it revenues and expenses in total and your income. Okay? Now revenues have a normal credit. That means that when revenues go up, stockholders' equity goes up. Expenses have a normal debit. And when expenses go up, stockholders' equity comes down. Okay? So in this case, we were looking at the income statement. So that you don't get confused, on the income statement, we have revenues minus expenses equal income. Okay, the income eventually gets transferred over to stockholders' equity. So I don't want you to get confused when I kind of move between these or among these different accounts here. In this case, we're only looking at what the income statement effect is. There was none on revenues. On the expense side, we understated expenses by $4,400, and since they work in opposite directions, that means that if we didn't make the entry, we would overstate income by $4,400. I hope that you understood what we did here. If you have any questions, please don't hesitate to give me a call, and I'll help you work your way through it. And that concludes this particular video.